Vehicle margin also improved, rising to 10.2%, up from 9.2% this time last year. That may not sound huge, but margin expansion like this, especially in a high-cost environment, speaks to better pricing and more efficient production. Management noted, as we started the deliveries of several models in 2024, such as the ET7, ES6, and ES8, we expect vehicle deliveries to notably increase for the rest of the year. That's important. NIO is now ramping deliveries across its NT 2.0 platform, and those upgraded models are driving both volume and profitability gains. Now, R&D spending also grew, rising to $438 million, up 11% year over year. But the company emphasized our strong product and technology pipeline will help us gain further market share in the premium EV segment. So yes, NIO is still unprofitable, but this quarter shows clear momentum in the right direction. And the market seems to be picking up on that, especially with delivery growth accelerating. The June and Q2 delivery update was the real turning point for sentiment. NIO delivered 24,925 vehicles in June 2025, an increase of 17.5% year over year. For the full 3-month period ended June 2025, they delivered 72,056 vehicles, up 25.6% year over year. That is a significant reacceleration. From the report, in the second quarter of 2025, NIO completed the comprehensive upgrade of its product portfolio, significantly boosting competitiveness. They achieved this growth while scaling their battery swap operations, now with 3,404 power swap stations worldwide. Battery as a service is proving to be a formidable infrastructure moat, and it's helping NIO differentiate itself from competitors like XPeng or Li Auto. Investors clearly responded to this growth. Before this delivery report, the stock was under $3.40, and since then, it's been moving rapidly. One of the main points discussed in several articles is the uniqueness of battery as a service model. And I do agree with those statements. It's a genuine differentiator for the company. Instead of buying a battery, users subscribe to a battery plan and swap depleted batteries for fully charged ones in about 3 minutes. That's a game changer, especially for people in dense urban areas or fleet operators who need to minimize downtime. While traditional EV makers depend on third-party charging infrastructure, NIO is building and controlling its own energy network and monetizing it. This also gives them predictable, recurring revenue and strong customer lock-in. Two things Wall Street loves. And it's not just analysts taking notice. In a recent visit to a NIO power swap station, Xiaomi CEO Lei Jun praised the experience, saying, "The entire power swap process is very smooth and impressive. The service quality was excellent." That kind of public endorsement from a major tech CEO adds serious credibility to NIO's service strategy and signals potential long-term relevance beyond just vehicles. Now let's talk about the price action, and it's honestly a pretty strong long-term setup that is brewing. The stock bottomed last month around $3.30, and since then it's surged to about $4.60. That's nearly a 40% move, but it's not just the size of the bounce, it's how it's happening that matters. On the daily chart, NIO has broken above all of its major weighted moving averages, or WMAs. That's often the first signal of a shift from a long downtrend to the early stages of a new cycle. But more importantly, on the weekly chart, NIO just cleared the 50-week WMA, something it hasn't done successfully in a long time. And here's the thing. The last few times NIO broke above this level with volume, it made strong runs toward the 200-week WMA, which currently sits around $7. That also happens to be a major resistance zone from past trading ranges. Let's not forget, this stock was a meme favorite back in 2021 when it ran up into the mid-60s before crashing. Right now, it kind of feels like the stock is being rediscovered. You're starting to see retail forums buzzing, FinTwit names are charting it again, but let me be clear, this isn't something to just chase. Position sizing matters here. If you're looking to get in, consider waiting for a weekly candle close above the 50-week WMA. If that holds, then targeting a move towards $7 makes a lot of sense, with a tight stop loss just below that 50 WMA in case it turns into a fakeout. That gives you a solid risk-reward setup without jumping in blindly, something you always need to be aware of when trading these types of stocks. NIO has seen a notable shift in institutional ownership over the past few years. At its peak around early 2021, institutions held nearly 500 million shares, a reflection of the massive EV hype at the time. But the narrative changed. As price declined into the $3 to $4 range, many large investors reduced their stakes. Today, total institutional holdings stand at about 230 million shares, the lowest level since mid-2019. What does that tell us? Lower institutional ownership often suggests a lack of confidence from big investors. They see the company as riskier and aren't deploying fresh capital, yet some respected institutions remain, like BlackRock, UBS, and Morgan Stanley, but their positions are smaller and not aggressive, indicating cautious behavior. This generally lines up with the fact that NIO hasn't posted consistently strong results. Major funds won't jump back in until we see meaningful delivery growth. In simple terms, big money pulled back and they're only inching back in slowly. That means retail and swing traders are driving much of the current rally, but institutional reluctance also introduces added volatility. It's a double-edged sword of upside potential and sudden retraction risk. Now, let's take a deeper look at the put-call ratio and why it may not be a standalone signal right now. As of today, NIO's put-to-call ratio sits at around 0.63 and the volume ratio near 0.39, both clearly in bullish territory. However, historical data shows this ratio has been consistently low and stable for months, averaging between 0.6 and 0.7 over time. That tells us a few things. Traders have been expecting upside for a while now, not just in reaction to the recent breakout. Since this trend has been persistent, the ratio by itself isn't a new signal. It's confirming ongoing bullish sentiment, not predicting a breakout. What matters is the context. This breakout from $3.30 to $4.60 triggered new call buying, especially on 5 and 6 strikes. Combined with rising volume and the technical breakout, it reinforces that this is more than just a retail fad. It's sentiment aligning with price action.